Do you know that less than 6% of active fund managers actually beat the market over a consecutive 3-year period? And let me tell you, folks, it gets worse the further it goes. Hi, welcome to the Money Growth Academy. My name is Dee, and this is where we demystify the stock market, simplify investing, and multiply your opportunities for financial success. Man, we're going to have some fun, but I want you to see this. I'm thinking about this, right? Less than 6%, of active fund. Now these are the guys and gals that know this is the professionals. These aren't the amateurs. Actually beat the market over a extended period of time. And I want you to take a look at this chart. Now this is a chart of a report of research that the S&P, it was done by the Standard & Poor's, and this is kind of a snapshot, and it shows you that active fund managers, their performance over consecutive 3 years. And let me tell you, it gets, as I mentioned, it gets worse as the time goes on. And so you can see the percent of funds that actually beat the market, 5.7 in large caps, mid cap 3.24, and small caps 4.60%. As we can see, these again are trained professionals that are doing this. So what I want you to get from that is this: investing is not easy. Oftentimes, what some call investing is actually not even investing. It's more along the lines of gambling or speculation, which is not investing, but it's hoping, right? And I like what General Schwarzkopf says. He says that hope is not an effective strategy. And, I'd have to agree with him, especially as it relates to investing. So I'm going to give you the playbook for free. Nothing you have to sign up for, but I'm going to give it to you right here to double your money in the stock market and how to do that. And because that's really what we're talking about, right? Is how to double your money in the stock market, and to do it consistently, and to beat the market pros, and to back it up not with truth and facts, but with evidence that you can go back and you can check for yourself and verify that evidence for yourself. I love to hear people that talk about, the way they win in Wall Street is they buy low and sell high. And well, the problem is it's not a strategy. And it's very difficult to implement because, well, let me tell you why. Because when the market's low, nobody wants to buy because they don't know how low it's going to go. And when the market's high, everybody's excited. No one wants to miss the big upside, so people stay in. So if it was as easy as buy low, sell high, there'd be more millionaires, obviously. And but instead what we have is we have a lot more millionaires from sharing with people or selling courses to people about how to make money in the stock market than we actually have millionaires made in the stock market, if that makes sense to you. So how do you double your money in the stock market? Well, actually the doubling part is actually the easy part. The more difficult thing is to improve the rate at which you double your money. So let's talk about that. So to understand this, I'll start with a very simple calculation, and it's called the Rule of 72. Now, some of you probably heard of it, and if you haven't, you're about to learn about it. And the Rule of 72, the way it's used is to calculate exactly how long it would take to double your money. So if I had an investment and I put in, how long would it take me to double that? And so let's say, for example, if I had $1,000 and I deposited it, how long would it take that $1,000 to double? And so this is how the Rule of 72 works. So you simply divide 72 by the rate of return that you'd like to earn. And the answer you get is actually how many years it's going to take to double your money. So you have 72 over R, which is rate, equals time to double. Very simple formula, but powerful. So if we had a rate of 2%, we'd express it in terms of just 2, not 0.02, not 0.2, or not 2%. We're going to just use the number 2, and that's how the Rule of 72 works. So 2% is expressed by the number 2. So 2 into 72, 36 years to double. So it would take 36 years at 2% for any amount of money that I had to actually double. So let's take this example. So we had a $1,000 investment and we were going to get a 2% return. And we figured that it'd take about 36 years to double and we'd have $2,000. And the reason I like to use 2% is because you and I can go get 2% all day today, right? We can go get it at a variety of online banks. As a matter of fact, we actually have a video called The Best Savings Accounts in 2019 that talks about these online FDIC insured savings account where you can get 2% and even better. So it is possible to get that. So I'd like to use that as kind of a baseline. But you're probably thinking, look, D, 2%, is that really investing? It's more like savings than it is investing. But you are trying to get a return, and that's relatively low. But I'll tell you this, most Americans are getting about 0.1% on their investments. So they're getting 0.10. They're just barely, they're not getting anything. So 2% is fantastic compared to 0.1%. So again, you can get that all day long at online banks. We got a video on that. You can go back and check that out. So it'd take 36 years to get to $2,000. So, but the thing to think about, a savings account is a near no risk savings account. It's certainly safer than putting it underneath your bed. So at the base level of investing or saving with virtually no risk, you're going to get 2%. But you also realize when you look at the time it takes to double, it's going to be impossible to save enough to have a decent retirement at 2%. But then again, you shouldn't be investing in a savings account to get better returns, right? Because it's obvious the rates are too low. We talked about that in that same video that I mentioned. But we're going to use 2% as our benchmark. So that's our measuring stick for how to get that done. It is the rate of return that we're looking to beat. It's our benchmark, but without significantly increasing our risk. So we want to see if we can do that. So we look at the next level. That's investing in the stock market in order to get a quicker return, right? To double a little bit faster. So is there a way to cut the amount of time to double our money? And can we cut it in half? Again, without significantly increasing our overall investment risk. Well, let's find out. Did you know that the Standard & Poor's 500, which is an index fund that tracks 500 of the largest U.S. companies, has averaged, and I'm not kidding you, it's averaged 9.8% rate of return over the last 90 years. Now, let me say that again. So it's averaged 9.8% over the last 90 years as a rate of return and has outperformed more than 95% of all investors over that period. Now, there's some more celebrated type investors like Warren Buffett and Ray Dalio, Charlie Munger, that have in multiple years over extended periods of time have actually outperformed the S&P 500. Those are extraordinary investors. So here's that graph. Here's a graph of the S&P 500, a chart of the S&P 500, and it is their 30-year historical chart. And so you can see from about 1989 through 2019 how it's performed. Now, if you look, in there's 2008, 2015. So when we look at nearly 39% drop and return, a negative return of 38.49%, and again in 2015 a negative 7.30, and then again in 2018, which we all just felt that, negative 6.24%. So even keeping all of those in the last 30 years, the S&P 500 delivered on average 8.64%, and that beat 95% professional investors. Here we're going to take a look at 4 top index funds from a few companies at least that track the S&P 500. And most of these index funds, they track 80% of the investable market capitalization and the U.S. equity market. So let's just take a look at those. So here we just took some of the top funds, right? We took 5 of them, and 2 come from Fidelity, 1 from Schwab, 1 from T. Rowe Price, and the big granddaddy, which is Vanguard. And provided the stock symbol, so you can go back and look these up, and the expense ratios. And the expense ratio, it tells you how much you're going to pay the mutual fund in a percentage term every year to manage your money. That's really important because that those fees erode away your total investment. So, and this fee is levied on your entire investment value yearly. And so it'll take 0.02% or whatever the percentage is. So you want a lower expense ratio. So what I'm going to do here is I'm going to use that 30-year historical return rate of 8.64, and I'm going to plug that into the rule of 72, and I'm going to use that to try to find out, well, if we were able to deliver 8.64% on average, and we plug that into the rule of 72, how long would it take to double $1,000? It actually would take about 8 years. Go ahead, plug it in the numbers, do it yourself on a calculator. It'd take just a little over 8 years. So we literally went from 36 years at 2% to 8.64%. We didn't just cut it in half, right? We got it down just over 8 years, really. A considerable improvement. And imagine at 10% return, then you're talking about doubling in every 7.2 years. And if you can get it to 12%, you'll double that in every 6 years. You're probably asking, right? Because I'm thinking the same thing. It says, okay, so, but how do I get into that double digit number, right? So that I can get those double digit returns. Well, that's a whole new video. That's a whole different video. That one's coming up. Make sure you watch that. Look for that one as it comes up. Because really the purpose of this video is really to talk about how to double your money, right? And how to do it and do it in a way that doesn't risk or put you at a greater risk of your capital. And it's really just a matter of time, a reduction of taxes, a reduction of fees, if not the elimination of taxes initially, and some consistency in investment. And it was Charlie Munger that says, the big money is not in the buying or selling, but in the waiting. Charlie Munger, obviously, is, if you didn't know that, he is the partner of Warren Buffett at Berkshire Hathaway, probably the second greatest investor of all time. So if you're going to wait, the S&P 500 is not a bad place to wait. And really, it's just really not a bad place. And so you want to take some time, take a look at some of these. This is what I'm telling you is not investment advice. You got to do what's best for you. This video is educational purposes only, entertainment and educational. And we want you to go back, do your research, come to your own decisions, figure out what works for you, what works for your family. But we want to put some information in your hands. We want to simplify the understanding of the information so that you can have it so you can go to work on your own. So anyway, thank you for watching the Money Growth Academy, where we demystify the stock market, simplify investing, and multiply your opportunities for financial success. And if you haven't subscribed yet, bing, 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 make sure you do that. Go ahead and do that right now. And if you like what you learned today, give us a thumbs up and leave us some comments down below. We'd love to hear from you. We'd love to know, are you using an S&P 500 type index? If you are, which one are you using? Maybe tell us a little bit about why. We'd love to hear that. Share it with the community. And again, we'd love to hear from you. So we'll catch you next time.